Abby, are you saying that stock markets are not accurately reflecting the fact that inflation would be higher and would remain higher even after this cycle collapse if the Fed were not to keep rates at a much higher level than they had been?
Another very good question. Let me just talk about what happened yesterday in response, and that is the equity market didn't know what to do. First it was up, then it was down, then it was up, then it was down big time. There was really erratic behavior because, to your point, Lisa, equity investors are really confused because there is this yin-yang between inflation and higher yields versus will the economy and earnings continue to grow? And I think we're now at a point where, given the significant rises in interest rates and yields across the yield curve since the beginning of the year, the equity market is now focused much less on inflation and yields than it is on earnings. And there's a lot of confusion. Investors are not sure how this is going to play out for the rest of the year, let alone for 2023. We see, for example, that there are ongoing adjustments to the consensus earnings forecast. But let me point out, we are starting at record profit margins.
Right.
It's not as if profit margins and ROE were low. ROE for the S&P 500 is in excess of 20%. So if there is, in fact, ongoing profit margin squeeze, I think the impact overall is not dramatic. The impact, however, in individual sectors may be significant.
Do you see the possibility of a lost decade, Abby, given the fact that we're trying to readjust and renormalize rates, renormalize some of the financialization of the economy?
You mean a lost decade in the
profits, in GDP, in a lot of things that people harken back to the 70s about?
Sure. I mean, if you look at the valuation of the U.S. equity market and some other markets as well, at the end of 2021, they were at record high levels in terms of where we were on percentiles. Almost every valuation model was between the 95th and 99th percentile, indicating, in my view, overvaluation, unless you believe that the dream scenario of extremely low interest rates and strong profit growth would continue uninterrupted. So where are we now? The valuations are roughly at average levels. S&P 500 PE, for example, is about 16 times earnings. And given where we are, even with a rise in interest rates, that's not a bad place to be. So when we talk about the lost decade, let's talk about two different phases. Number one, we've now had a 20% correction in share prices from record high levels and record high valuations. Can we get back that 20%? I don't think that happens over the next several months. Over the next few quarters, I think the economy will slow, earnings growth will slow, but I think it's possible that we could see higher equity prices. I kind of peg that along the same lines of the growth in earnings, which is probably, why don't we call it 5 to 10% over the next few months.